Hi everyone, Crystal here from Pet Biz Advisors, and I want to talk to you today about the big, beautiful bill and kind of what that means for you as a small business, right? So, right now, what's happened with this bill, and it is for your information, it's the HR1. It's called the One Big Beautiful Bill Act. That's how it's listed on congress.gov. And what I did is I took the information and actually put it into Chat GPT because AI is the wave of the future, right? So you have to be careful though with AI because it sometimes gets things wrong. So I did try to go back and double check some of the information it gave me. So I think we're good. If you notice anything that you question, please let me know with that. Okay. So this HR1, essentially what it means, I want to go over that and then it's just kind of do a brief overview. And then mostly though, how it's going to affect you as a small business owner. Because that's what I'm mostly concerned with, because there's a lot of stuff in this bill. A lot of it, of course, it all does directly pertain to us, but I want to know how it works for you as a small business owner. So, just a quick overview. And again, sorry, I'm looking across because I have to read this, right? So, I want to make sure I get everything okay. So, it was passed by the House on May the 22nd, 2025, and it is now in the Senate. So, what does that mean? Well, the Senate basically will debate and they will vote on this bill, but there are already changes that have been made in the Senate version of the bill to kind of make some compromises a little bit. And mostly those are related to green energy. And I'll go over those in just a minute. But essentially, it has to go back to the Senate and then it goes back to the House to be certified, essentially. Well, the House may not decide to go with it depending on what the provisions the Senate makes in that, right? So the Senate might push it back to the House to be re-voted on, and they can be like, nope, we're done. We're not doing that. We don't like your provisions, and we're not going to vote for it. So this could really be all dead in the water. Let's just call a spade here. But there are some things that I personally, as an accountant and a small business owner myself, would like to see happen that is in this bill. There are other things that make me a little questionable with this, but for the most part, I would like to see some of this happen. And so we'll just do an overview real quick. So what does this mean? It extends and makes permanent most of the 2017 Tax Cuts and Jobs Act provisions, such as lower individual tax rates, higher standard deduction, and then the QBI pass-through deduction, which is the qualified business income deduction. So, in numbers, what does that mean for you? Well, the QBI, just in very layman's terms here, so accountants don't come for me on this, but essentially it's a 20% deduction on your net income, so your taxable income from your business. This is good for sole proprietors, this is good for single and multi member LLCs and S corporations. So they all get to take advantage of a 20% deduction on that net taxable income, which is very beneficial. You can imagine. So that's what happens with that. It introduces new temporary tax breaks, which some of these I haven't heard before, but it's very interesting. So, untaxed tips and overtime, we've already talked about that, and we're still waiting on that to come through, like that just initial, the no tax on tips law to come through. But what this would do is make that more permanent, essentially. So, charitable deductions for non itemizers. What is that? Well, essentially, when you give donations to charity, now, unless you are a C Corp, technically you're not supposed to be giving donations on your business tax return. I will repeat, only C corporations are technically allowed to give donations on their business side of the tax. So, yeah, a lot of people kind of miss that one because essentially, if someone gives me a tax return, I put it through on the Schedule A, which is the itemized personal deductions. So that's how we have to treat that. But with that being said, right now, unless you make enough to itemize on your 1040 individual tax return, you don't get that deduction. That's the way it is written now. So your standard deduction might be more than your itemized deduction. So therefore, that charitable tax donation doesn't affect you one way or the other. What this does is it says, okay, taxpayer, you can actually make a charitable contribution and get to record that even if you take the standard deduction. So you get that benefit, which is, I think, pretty awesome. Unfortunately, I don't like the way that a lot of charities sometimes try to say, "Oh, it's a tax write-off, it's a tax write-off." It's not always a tax write-off. If you don't itemize, you don't get the benefit of that. So you have to be really careful with that. So, but this will actually make it more beneficial to even give. Now, I personally feel like you should give to charity because you want to give to charity because you support that cause. And that's why I do myself. But hopefully this will be even more of an incentive for people to give. The other thing that I found interesting is the Trump account for education, home, and business expenses. Now, this one, I mean, I have heard about, but I only heard about it partially. So let me pull up real quick what these Trump accounts are. Now, I'm taking this from CNBC. It's just a really quick, decent overview. So, a new savings account for children with a one-time deposit of $1,000 from the federal government is remained in the U.S. Senate's version of the President Donald Trump's budget bill. So, the Trump accounts essentially are a type of tax advantage savings account that would be available to all children under the age of 8 who are U.S. citizens. In earlier versions of the proposal, Trump accounts were termed money accounts for growth and advancement, or MAGA accounts, but now they're called Trump accounts. So, if the bill passes as drafted, parents will be able to contribute up to $5,000 a year, and the balance will be invested in a diversified fund that tracks a U.S. stock index. Now, please keep in mind it says that they will be able to contribute, not that you have to contribute. Okay. You can just leave that $1,000 in there, don't touch it. And the idea is that it will grow at a fairly rapid rate. Obviously, it'll grow a lot faster if you contribute to your child's account, but you don't have to. You're not required. So, this part of the Senate Republicans' version of the One Big Beautiful Bill Act was largely unchanged from the House plan advanced in May. So, that part they're saying that the Senate hasn't changed that. They're in agreement with that. What this kind of does is it actually privatizes Social Security. So you know how we have to pay that 6.2% to our Social Security on our paychecks, right? Well, what that will do is that will actually go away. And so the children will actually, now it probably won't for us, just full disclosure, but the newer generations coming out will get the opportunity to be able to do this. So what they'll do is they'll set up this money. The idea is that it will grow in a privately held fund that the government does not have access to. So therefore, it's privatized Social Security, which is to me, it's a kind of a cool thing. That way, it gives people a leg up to be able to do things with their education, buying houses, and starting a business, because that's exactly what this will happen. It says, not unlike a 529 college savings plan, the accounts will come with a tax incentive. Earnings will grow tax deferred, and qualified withdrawals are taxed as long term capital gains, which those are a lot less than ordinary income tax rates. So you don't have to pay as much in taxes on that. Under both the House and Senate versions, withdrawals will begin at the age of 18, at which point account holders can tap up to half of the funds that are available for education expenses or credentials, the down payment on a first home, or as capital to start up a small business, which I love, love, love all of those. I think that gives people incentive to actually start their own businesses or go to college, whichever they want, or both. Because I believe you can pull out funds starting at 18, 25, and then 30. So that's kind of how they do it. And notice they said they can only pull out half of what is in there, because the idea is that they want you to save, keep some of that in there for retirement. That way you can pull out the rest of it. I believe you actually can pull out the rest of it at 30 or older, but that's just where we are now. So what are your thoughts about that? I think that's really kind of cool. I don't like the idea of government having full access to my Social Security, because even though I've been paying into it, and I'm sure you guys have too, I doubt we're going to see a cent of this. Like, we're not going to see a cent of the money we have paid in. It's already gone at this point. So therefore, I really do encourage you to start a relationship with a financial planner and a financial advisor in a wealth management company because they can help you get into the right vehicle for you. Not a car, but the actual, retirement vehicle, a retirement product that will help, you save for retirement. That way you're not having to depend on Social Security at that point. All right. So that's one of the cool things that I really did like about this. So, the pros and cons, I'll kind of go over this real quick. The pros are the lower taxes and higher deductions that we just kind of went over. New credits, expanded child care tax credit up to 50% for eligible persons above the line deductions. No tax on tips or overtime. The charitable deductions and the Trump accounts. Cash flow relief, continued 100% bonus depreciation through 2029. It allows immediate expensing of capital investments, and this is sometimes vital for small firms, and I do agree with that. Depreciation is a tool that I personally love as an accountant because you can utilize it however you need. Let's say you're a new business and you didn't make a lot of money in the first couple of years because most small businesses don't. They typically have a loss in the first couple of years. And one of the reasons is because depreciation is not being utilized correctly. So you're taking a lot of accountants will just take the full depreciation on year one. But the thing is, guess what? You don't need that full depreciation. You already have a loss. So I would like to use that. I use it as a vehicle or a strategy. Essentially, I'll take a smaller amount or just do straight line depreciation. Therefore, you have more money to take in later subsequent years. Therefore, you can offset that tax deduction or that tax liability. So it's more beneficial that way. Now, some people, it makes sense. It makes absolute sense for you to take that depreciation all in year one because you might have had a boom year. You might have just exploded out the gate. This is wonderful. But some people, we need to kind of utilize that in a little different way. So, okay, so the deductions over time, let's see, and regulatory relief. Senate committee moves to reduce regulatory burdens in areas like financial oversight and CFPB funding. So there's not going to be as much, the financial oversight for small businesses. The neutral tax, lower salt cap stays at 10%. May benefit small businesses not paying high state and local taxes, though still a constraint for many. So the lower salt cap stays at 10,000. I think I might have said 10%. Sorry, it's $10,000. So essentially, what that is your state and local state and local taxes. I think you may have noticed if you have a Schedule A and you take the itemized deduction, your, say, property tax, for example, you can only take up to $10,000. So it's like your state, local sales tax, your total could only be $10,000. Well, it depends on what state you live in as far as what your property taxes are. This may not directly impact you, but for a lot of people, it does, especially if they're in higher income tax or property tax states like California, New York. They're only getting a very small fraction of the property taxes they pay. So it's really detrimental to them and also for even the small businesses as well. So, what are some of the disadvantages of this bill? So, social safety cuts, reduced SNAP and Medicaid resources may shrink consumer demand in low income communities where small businesses often rely on customers served by these supports. So, it's basically there's going to be SNAP and Medicaid exclusions and provisions that actually can directly affect, especially lower income neighborhoods. That can actually affect small businesses because some small businesses actually do help, with support of the SNAP and Medicaid provisions with that. And so that's going to be drastically reduced. And so therefore, as a small business owner, you may see actual decrease in your revenue because of that. So green energy rollback, it eliminates clean energy credits, and that could raise operating costs for small businesses investing in energy efficiency or EV fleets. Deficit and debt risk, massive 2.4 to $3 trillion deficit increases may trigger future tax hikes. Actually, I think right now it might even be up to 4 trillion unless they've done the adjustment in the Senate and lowered it. At one point, it did it was at $4 trillion for future debt. So it might trigger future tax hikes or increased interest rates. Small businesses are vulnerable to these macroeconomic shifts. So therefore, if the interest rate goes up, that does tend to affect us all, obviously, in small business, especially if you have an adjustable rate mortgage for anything, or not mortgage, but adjustable rate loan for any reason. So compliance burden and new tax provisions, the Trump accounts, no tax on tips and overtime, and then the QBI deduction add complexity and potential compliance costs for small business accounting. Now, some of this, yes, I will definitely say, especially the no tax on tips and overtime, but the way technology is now, we can probably get over that hurdle pretty quickly. They're going to make like a lot of our tax softwares, including payroll softwares, we're able to handle this, and we're going to write code into this. The tax code, no matter how they're wanting to state this, it changes constantly. So our tax software changes year after year to year, sometimes even month after month. It just depends on what provisions are coming out. But most of the time, the tax software companies do a really good job on maintaining that compliance. So I don't think it's going to be as complicated as what they want to make it seem like, unless people are still doing, returns manually, like payroll returns, which why? But if you're doing it manually, then yeah, I can see a problem with that. The biggest one would be the no tax on tips and overtime. And then the uncertainty risk, many business tax breaks are temporary, so only 2025 through 2028, creating cliffs and planning challenges. So we don't know, yeah, this will be great for the first few years, but is it going to be permanent? Is it, because a lot of these are temporary. So yeah, so that's going to be essentially what's happening. So bottom line, for small business owners, this bill delivers meaningful tax relief, cash flow improvements, and some regulatory simplification, all attractive for investment and hiring. However, benefits are clouded by uncertainty due to temporary nature of many of the provisions and the potential downsides from social program cuts and looming financial strain. So, businesses that serve lower income customers or invest heavily in clean energy, such as EVs, may face indirect pressure. So, let me know your thoughts. I just wanted to kind of give you an overview of what we're looking at because this will directly affect all of us. So, I wanted to make sure you guys, as business owners, knew what was coming and what could possibly happen with that. Again, I have not heard anything yet on the no tax on tips for overtime yet. So, I will keep you posted as soon as I hear something. All right. Thanks, guys.